All right. Well, after after many fits and starts with technology, welcome to BDE. And I guess I'll borrow Chuck's little ditty. I don't know all the words to it. Guess who's back? Back again. Dave Pursell's stepping in as guest co-host today, and wanted to kick it off with maybe revisiting what we talked about in our special edition last week. So you were on regular BDE. We're going to cover a bunch of other stuff, but Jacob, our producer, technology guy extraordinaire, and by the way, all the technology difficulties this morning was my fault. So here we are Friday afternoon recording. But, Jacob was quite intrigued by the Chavez Archie Dunham story that you told after we finished. We were both witnesses to that. Maybe you can set that up for us and give us a little run through.
Yeah. So again, thanks for having me, guys. This is a lot of fun. Yeah. So the Chavez story was in shortly after he was elected in Venezuela. So this was years ago. He came to Houston and spoke to a really large group. I don't know. There were Mark, you were there. There were 500 people or more in a massive ballroom. It was kind of a non-oil group. It was more of a, I don't know, just a broader interest in Venezuela group. And the two CEOs who introduced President Chavez were Archie Dunham and Jim Mulva, heads of Conoco and Phillips, who subsequently joined, but at the time were separate companies, both with big investments in Venezuela. And we're talking about what a great place it is to invest in Venezuela. And I'll tell you, as someone in the audience, you could tell their heart wasn't in it. And as Archie Dunham was talking, he talked about all the opportunities in Venezuela, and he said there's even natural gas in the Gulf of Paria. And President Chavez stopped him in the middle of his speech, and he stood up and he said, "Senor Dunham."
On this big stage kind of dais, right?
Yeah, massive stage. And Chavez is in the front row, and he stands up and with no microphone stops him and says, "Senor Dunham, how did you say Gulf of Paria? Say it with me. It is Golfo de Paria. Say it with me, Senor Dunham." Now, if you put a gun to Archie Dunham's head, he couldn't roll an R. Okay. And it was like, he probably had 5 more pages of his speech to do. And he quickly got to the end and sat down. And it was one of those moments. And then President Chavez got up to speak. So everyone had, headphones on. It was a simultaneous translation sort of a thing. And if you could imagine a Hugo or a Fidel Castro-esque kind of long-winded diatribe. I mean, this thing was a 2 hour.
I want to say he was wearing like a plum or maroon suit. He was wearing red.
Yes, it was kind of a whole different thing in every aspect. And he spoke for a couple hours, no notes, no prepared remarks. It was just off the cuff. And in the middle of it, so we've got the simultaneous translation, and it's like, oh my gosh, you can't take your eyes off this thing. And then he started singing. He started singing this song, and the translator said, "Okay, I will not sing along with President Chavez. However, what he's singing is a revolutionary song that harkens back to the Bolivarian Revolution." And she talked about the meaning of the song. And I've never in my life seen a speaker just start singing in the middle of a talk, let alone a 2-hour long kind of Castro-like diatribe. And Jeff Dieter, our colleague at Simmons, was covering Conoco and Phillips at the time. And we walked back to the office, and I think Mark and I both walked in his office and said, "Dude, those assets are gone." It's just a matter of time before
and it was.
And they were gone eventually. It's just, and that's ultimately what happened. And then Maduro, and we are where we are on Venezuela now.
Yeah. And I went back last night and was thinking about what the timeline was from that experience to seeing Hugo Chavez at the UN General Assembly, where he ranted and raved and called George W. Bush El Diablo. And so I went and found something that I couldn't find for a while, and I call him the kind of OG shit poster. This was 2006, UN General Assembly, when Chavez was on fire and calling Bush the devil. And I don't know if you remember the kid from Brooklyn.com. He's this old man sitting in his basement in New Jersey, or in Brooklyn, in a wife beater T-shirt, and he would go off on all kinds of in his video postings on different cultural and political things. But he took this Chavez speech and the El Diablo thing to task. If you can find it, it's funny. It's typically profane, but I got a good chuckle out of that last night. He's giving him the sign, you Chavez. Anyway, so fast forward to last Friday, and we've got, a big public unveiling, or the press conference that Trump held. And I watched the entire 90 minutes. And so you had the vice chairman of Chevron in the room, name escapes me. I think it's Mark Johnson, but don't hold me to that. You had obviously Darren Woods, and then you had Ryan Lance, were I think the three most prominent U.S. Large oil co CEOs. And then you had, the relevant cabinet was there, Harold Hamm was there, et cetera. And you could tell right from the outset, it was, we're ready to, once we finish this press conference, we're ready to sign $100 billion worth of deals. And then it got to the prepared comments or opening comments from Woods, Chevron, and ConocoPhillips. And I think one of the things that you and I talked about in the piece we did last week is there's a ton of just assessment that any one of these companies that's not already there. I mean, Chevron's got the I don't know if it's an advantage, but they've got the presence there. I joked with I joked with Arjun over the weekend. I said, never has Mike Wirth been more happy to have had knee replacement surgery that prevented him from traveling to Washington. So, and Woods, I think Woods' quip on, I don't know if it was a quip, he means it, but, Venezuela as it currently stands is uninvestable. Yeah, we can get an assessment team in there in a couple of weeks, but don't misinterpret this to mean that, we're ready to execute deals. And then immediately after that, there's a flurry of social media posts by Chris Wright, and then ultimately President Trump. Chris Wright said, he called Exxon's view an outlier, and then Trump is basically putting out there that maybe we won't invite Exxon to participate. So.
Yeah, and I don't think it's an outlier. I mean, I think no. Exxon is not investable today is the rational conclusion of 20 years of technical exit, right? The technical IQ of the country used to be really high. It's much of that's left. There's been lack of investment, and the country took over assets. So what is the technical challenge? But more importantly, what's the fiscal framework?
Right.
So and ultimately, if you look at almost any country with a production sharing contract, that's approved by the government, by the parliaments, or this isn't something that two guys sit in a room and hash out. It's much more complicated than a traditional tax and royalty scheme like you have in the U.S. And so what's the fiscal framework? And, what kind of investments are we going to make? And when do we expect to get a production response from that? Those are all kind of logical and rational business decisions that any one of those companies or the other 25 companies who are apparently in waiting to go in, they're going to make and they're all going to make the same decisions. Or use the same decision process. Some are better at heavy oil than others. Well, they have an advantage.
Well, Ryan Lance showed their kind of wait a minute. We got some kind of clear and present issues we need to deal with, namely for ConocoPhillips. I believe they're the largest creditor to Venezuela to the tune of, somewhere between $6 and $12 billion. And basically there was almost immediate pushback. Well, you're not going to, we're not going to really address that, but you're going to make a lot of money going forward. And, I think that is, Exxon's been fooled twice, as Woods alluded to back in November of last year, and then ConocoPhillips had its turn in the woodshed, and so I candidly I don't really think it matters, just given what they're trying to pull off politically, and you don't have a short time frame to get the political situation sorted out, because you've got Maduro vice president as interim president. What's changed in terms of their political view toward adjusting anything, whether it's PDVSA, whether it's the commercial terms, contractual terms, concession agreements, and all that. Never mind the fact that we've got a tremendous amount of midstream and downstream capital defined as upgrading, rehab, overhaul to put in place, and that certainly doesn't happen. I think in the extreme, I was joking about it a little bit. I was after the uninvestable, and Chris Wright calling it an outlier, and Trump saying Exxon may not be invited. I put a little tongue-in-cheek internal bet out. I said, what's the over-under in days before Trump refers to Darren Woods as a quote-unquote low IQ person, which tends to be one of his favorite insults. So, I saw something, it was 2 or 3 days ago. Ven crude is, I don't know if there's a real kind of import benchmark we can point to, but for a lot of reasons, $9 under WCS, which is, they're not immediately interchangeable. All the Sen crude coming down from Canada is not something that is, replaceable in terms of all the capital mods that the refiners did over time when there were more and more barrels coming from Canada. Completely different animal. You're talking probably upgraded Canadian crude at 20 API for one, diluent spiked Ven crude in the high single digits to low teens API. Never mind all the other stuff that, is in the quality attributes that are different. So reality is, I think at least been introduced by the comments. You can kind of read between the lines and dig into more of the detail as to what the reality is of the companies and their leaders, and ultimately the boards in making decisions of what, of how this is going to work, if it is going to work.
Yeah, I think just the magnitude of the potential capital and it narrows the playing field to just a handful of companies that have the balance sheets and have the expertise and have a portfolio that allow them to actually move and be a first mover back into Venezuela. So I don't think there's all that much competition actually for the opportunities.
It's going to be fun to watch, continuing to unfold. And Jacob, I saw, I guess, a repost from Shy Girl Tracy Schukert, and she pointed out a lot of the technical realities of Ven crude versus Canadian crude, and we'll post the link to that. There's going to be more to come from Venezuela, but let's shift gears to I know a subject that is very near and dear to you, which is the EIA, and they published their January short-term energy outlook, which, if you look forward into the early to middle part of 2026, is not all that different from what they were showing in the December update. but there is a pronounced rollover in U.S. production that is already underway. And I think the last 9/14 was still at that 13.8 million barrels a day that we talked briefly about last week in the dog's breakfast of things of global crude macro. What are your thoughts on the EIA? We can get into data quality, et cetera. We had quite a running string of questions and I think comments about, almost building to the level of some kind of conspiracy in the EIA data not really being representative of what's happening on the ground, particularly in the Permian.
Yeah, I think generally, if you look, my experience has been the EIA are exceptional data gatherers and statisticians to tell you what production has been or what refinery output has been or whatever the number we're looking at. They're pretty good at the most recent month of data they have and backwards. Not perfect. They're subject to revision, but they're statistically very, very sophisticated. Sometimes they don't forecast all that well. And that's the nature of the beast. I think when I just look at what they're saying, so again, U.S. oil production is 13.8 million barrels a day. Global, again, on a global basis of 100 million barrels a day, roughly. And it's been a growing piece of, it's where a lot of the global growth has been outside of OPEC in the last little bit. They're showing 1% decline in 2016 and 2% decline in 2027 in U.S. oil production. That actually makes sense to me, right? If you just like, well, what? And again, that's that top line 13.8. The Permian is half of that. So if you say, well, even the Permian could even grow a little bit in that forecast if the rest of the U.S. is falling, which it probably is. And, the big pieces of the rest of the U.S. are obviously Gulf of America or Mexico, depending on your choice. You've got a number of other places where production is clearly not growing fast. And you look at rig count in the Permian, you look at what happens with $55 or $60 oil, you look at cash flows in a world where companies are showing they are disciplined around cash flow, and they'll absolutely quit growing in order to show cash and continue to have higher returns to shareholders. So I think the top line, it makes sense to me that U.S. production should plateau and start to decline. So particularly in this oil price environment, companies are reacting that way. You see rig counts slowly declining, and it will continue, I think, as long as oil prices stay here.
Well, Chuck and I talked about in regular BDE, kind of in our year-end review, we talked about what happened to, I think there was a surprising recollection that, hey, crude started the year at 70 last year and we lost 20%. Rig count did what it did. I showed the contemporaneous trend in frac spreads. But what I didn't have on that graph, and we'll post it, there's an X post from Jorge Arjona, and it has an overlay of completions over that same time frame, and the completions line is much flatter, certainly in the second half of 25, than the frac spread count, which continued to drop fairly precipitously. I mean, we were at over 200 or so, and then completions have held pretty steady between 900 and 1,000 per month through the back half of the year. So there's something there fundamentally if those data are correct, and I don't have any reason to believe that they're not. I guess I'll pose the question this way. Just given the kind of the step up from the 13.5, 13.6 to 13.8 against the backdrop of declining rigs, declining frac spreads, do you think the likelihood of downward adjustments to kind of latter half 2025 914 data is elevated, or is it about the same? I guess what I'm asking is, would you be surprised if we saw some pretty meaningful adjustments?
No, I wouldn't. And remember, the 914, the statistical challenge there is they're surveying the largest companies, okay? And they are not surveying the smallest companies. And so the assumption is behavior between the large companies and the small companies is the same. And statistically, that creates a lot of challenges. And I'm oversimplifying it, but you could easily see some downside revisions as the actual data starts maturing. And the other reality is, I think they forecast some low oil price in 2027 as well. No chance. If production is down 1%, if they're right on production, they're wrong on price. That I am sure of. If U.S. production is falling this year and falls even further in 2027, there's no way 2027 price is low. Supply and demand catch up, and prices are much higher in 27. I don't know how much, but they're much higher than they are today.
I saw a Brent forward curve 3 days ago. Rory Johnston, those of us who no longer have Bloomberg Professional have, we're a little bit handcuffed. Most ingenious addiction ever invented, but pretty steep backwardation throughout 26, but it goes sharply contango into 27. For whatever that's worth.
Well, and so what does backwardation mean, right? I mean, I think it's worth, Mark, an interruption and a pause. So backwardation means that for the next 12 months, futures prices are lower than they are today. Okay. Well, that is an abnormal sort of curve. The curve should be in slight contango. In other words, the futures curves over the next 12 months should be slightly higher than today. And that the level of contango in a balanced market should be the cost of storage. So I should be indifferent. Do I produce a barrel today and sell it to Mark? Or do I sell it to Chuck 6 months later and he, and again, whatever, if it's $2 to store or $1 to store over 6 months, that should be the contango. Backwardation is telling you the market's tight and that the market is saying, look, I don't care what the price, I don't care about 6 months from now. I need those barrels today. And it's not only is it not creating an incentive to store, it's creating a disincentive to store. It's creating an incentive to liquidate. That's why Cushing, you got 80 million barrels in Cushing of storage where the NYMEX physically trades. It's sitting there in the low 20s, sitting just barely over minimum operating levels. So I think
if I recall the last week's inventory report you had, or maybe last week's, you had like an 800,000 build, and that may be API that comes out on Tuesday evening. And so your point is that from a structural standpoint or kind of endpoint levels, given we talked about it a little bit last week, but just given the kind of the perceived glut and the narrative that's out there, Cushing would have responded over this time frame much more than it has in terms of inventory builds.
You would see the barrels in Cushing. You'd see them on the U.S. Gulf Coast because you have the ability to arb the physical and financial in those areas. And historically, when the market's oversupplied, that's where you see the barrels show up. And what you'll hear people say, and we talked about this last week, well, it's China. Well, China's convenient because you tell me they're being held in China, I can't prove you're wrong. You can't prove they're there either. But what we do know is the shape of the forward curve is telling you the market isn't wildly oversupplied. It's probably tight. And if it's tight today, with OPEC barrels have come on the market over the last 12 months, what it says two things. Demand is either better than consensus believes, and or OPEC isn't putting as much oil on the market as they say they've put on. And some of the OPEC countries have struggled with capacity at times. Those are both logical. And if either or both of those are true, 2027 is teed up to be a really good year. If U.S. production starts to fall with good demand and OPEC with less excess capacity than people believe, this is going to be a really good oil market.
Yeah, and the thing we have the best data quality on, we can argue whether there's some kind of narrative led, I don't want to say massaging, but always cross-reference production with the best inventory data defined as OECD and US.
Mm-hmm.
And think about what you're seeing in terms of builds or draws. In absolute levels. I mean, I think we've had a relatively robust gasoline build over the last few periods, but structurally it looks like we ought to be setting up for evidence of a kind of a tighter circumstance, and I think that's what you described. As you described what's going on with the forward curve, steep backwardation now heading into contango or reversing into contango. So another element of this that's been in the news. Let's shift gears. One of your favorite international topics is Iran. So give us a little backdrop on Iran, just from a foundational or fundamental perspective.
Yeah, so Iran's 4 million barrels a day. They matter a lot. Matters way more than Venezuela. I mean, Venezuela's 1 million barrels a day that might be growing to 1.5 million in 5 years. So it's, there's we were all probably spending too much time on Venezuela, but it's because people care about it. But Iran matters. It's 4 million barrels a day. And what happens domestically in Iran is really important to oil markets, right? If there's revolt and unrest and you put even just 1 million barrel a day kind of speed bump in front of Iran production, that's going to make a big deal to the oil. That will be a big deal to the oil markets. And so how this plays, yeah.
And since the Trump administration was anticipated, 96+% of the shadow fleet exports are going to China.
Yeah. I mean, there's the kind of Chinese, second derivative effects of what's happening in Iran. We know China's been investing both in the upstream and in the downstream in Iran. And so, again, the location matters. You look at a map and it's right there by Iraq and Kuwait and across the water from Saudi. And, you've got issues of sea traffic, tanker traffic coming through the straits. And, that's been an issue for 40 years and off and on. And there's just a lot of variables when you start to think about unrest in Iran.
Yeah, I think we're kind of showing our intent or willingness. I think the USS Abraham Lincoln Strike Group got underway from Asia Pacific to move into the Persian Gulf region. That's going to take about a week. I think that started yesterday or the day before. And, you hear updates on the news about, Trump's keeping it on the table, but there's a shuttle diplomacy going on, or the shuttle communications. Look, I don't know what their sources are. They've stopped the killings. They halted. I think they were scheduled to have 800 executions yesterday. So who knows? Brent took a hit when, that exchange was made, and we seem to have back off to a slightly less kind of hawkish stance. One of the things I want to get into is, and I read it in some posts, but of that 4 million barrels a day, you've got 800,000 or 900,000 barrels a day that's condensate, and I think as well as anyone, or maybe better than anyone, that South Pars is a big giant gas condensate field. And the interesting thing there is that domestic electricity in Iran is 80 to 90% gas fired. And about 3/4 of that comes from South Pars. So you got to produce the condensate.
Yes.
I don't know I don't know what the split is in terms of what's being kind of driven around offshore in floating storage. You got tankers anchored, but you have some kind of doing these 2-knot circles, apparently, that some of the ship watchers like Kepler and others have data on are loaded with condensate. So what kind of particular issues where you're not able to, you have to keep it on the tanker for maybe months, not weeks?
Yeah, I always think about condensate as being best blended with crude if you put it on a tanker for any length of time, or you end up with a bunch of evaporation. And so it's a question of what's the API gravity of that condensate, how light is it?
And there's an inherent degradation because of that VOC evaporation, for lack of a better term.
Yeah, it's something to consider.
Kind of the workability or the refinability of the condensate.
Yeah, and then who wants to take a pure condensate into their refineries, or do they blend it? I mean, there's always those issues, and it's good to point that out, Mark, that they do produce a lot of gas, and there's a lot of condensate in that kind of 4 million barrels a day.
They can't stop producing condensate because they can't shut the gas off, which would create a lot of power problems at a very, very precarious time.
Yes. Yeah, you've got to you have to keep the power on, or it just leads to further unrest. So no question.
I think there's some parallels here if we do ultimately get kind of organic regime change through citizen uprising. It's not a straight line path to kind of a democratic, more capitalist friendly situation in either Iran's case or Venezuela. And so kind of who's minding the store as this plays out over the next several weeks and months. And then the notion that Western capital is going to, be right there alongside whatever the new leadership looks like, whatever the new national oil company structure looks like, is not something that, that just flip the switch and, we're back to the old Iran kind of pre-revolution, and we're back to the old Venezuela pre-Chavez.
Yeah, I always think back to a comment. We were talking to this was a number of years ago, a European major CEO, and there was questions about, this is when we were at TPH, and we're talking about investing in Iran. And I said, well, look, you guys have the advantage there because you're at least politically able to invest in Iran, where, Exxon, Chevron, et cetera, U.S. domiciled companies are not. And he said, well, that's true. But he said, you do know, or we do, we're very aware that when we invest in Iran, the people who benefit are the Republican Guard. And that's really hard for us to do. Whether we're allowed to do it or not, it's kind of the moral case for not investing. Now, the flip side of that is if you get regime change in a more democratic group in Iran, are these European majors going to be a bit more willing to step into that. Again, you've got the same issues in Venezuela. You need stability. You have to understand the contract structure, etc. But those European majors may be a bit more advantaged as far as first mover.
I had an opportunity a few months ago to take a look at perhaps an advisory role, and it involved the Kurdish region of Syria. And so there's a lot of hydrocarbon wealth potentially concentrated in this region, and it's very regional. And then you've got the Syrian national element, and so we're doing all these things at the federal level. And there was clearly going to be a lot of kind of faction friction between kind of the provincial area that has the assets, and the U.S. is certainly backing a more kind of nationwide unity and a federal approach to recovery in Syria. And then you've seen what's happened from a kind of outburst of violence and stuff. I just know. My wife said, "You're not going over there anytime soon," nor did I want to. And I look at that as kind of an extreme example, but there's a lot of useful kind of analogous attributes to that in terms of what's going to happen if this type of progression and transition takes place from extreme kind of dictatorship, certainly one that is a theology based, or one that has the hallmarks of what Venezuela has been suffering under for 25 years, because you don't know kind of the secondary and tertiary players that have been without for so long, and now they rush into these pockets of a vacuum, kind of figuring out, and is there this immediate kind of this goodwill of unity across the country? And I think there's history and reality would show you that there's going to be some skirmishes, whether those are political or actual kind of military, that are going to sort themselves out. But again, it's not it's not a set table for the industry to flip the switch and let's go get things back to kind of best in class state with Western capital, Western technology, Western know-how. And so it just seems like that uncertainty and that instability, that intermediate instability, ought to be priced in a little bit more. And we joke about it because we used to have a tropical wave and off of Africa, and gas prices would spike, but the whole kind of weather and geopolitical risk premiums that we used to know and love are nowhere to be found.
Well, you're right, Mark. If you go back and look at history, right, there was, I don't know how many years ago, the Iranians allegedly fired a missile into the kind of Abqaiq kind of gathering system in Saudi. Now, and oil markets yawned. Well, okay, for people who don't know, that's a square mile of fence line where a significant portion of the Saudi crude from Ghawar and Abqaiq run through this. I mean, that's the most important square mile on the planet as far as oil markets are concerned. And there were missiles fired in there, and the oil market yawned. The U.S. recently dropped a bunker buster in the nuclear to sideline Iran's nuclear arms program. Oil market, for the most part, yawned. And so I think the oil market's saying, well, okay, I'll watch it, but I need to see a sustainable production impact before you see it really show up in the price. And again, you're right. You'd see crude spike on all sorts of news and rumors, and now it's, no, show me. You got to show me a production impact, either positive or negative, before the market's going to react meaningfully.
In 25 years after the start of hostilities in Iraq, we haven't seen a smooth up and to the right there either.
No, absolutely.
So a lot of lessons there, a lot of lessons to kind of bring forward and frame how you think about things, trying to understand the disconnect between fundamentals and more momentum or headline-based factors. Just an interesting stew of kind of exogenous things here in the oil markets. All right, let's move on. Gosh, this has been one of our long-running BDE favorites, which is the BP follies, right? I don't know if you saw the other day, they pre-announced a $4 to $5 billion impairment strictly related to their transition and renewables portfolio. Their last 3 years impairment trend overall, not all renewables, so keep that $4 to $5 billion in mind. In 23, they had total impairments of $5.7 billion. Last year, or 24, was, I think, 5.2. And then this year, meaning 2025, that $4 to $5 billion is on a total impairment of $6.9 billion. And so I just saw a video post on LinkedIn that Javier Blas, the Bloomberg energy reporter, longtime energy reporter, who's great. He loves to talk about BP and Shell, obviously, because he's based in London and he's from Spain. But he was just thinking in the graphic, it was, did you know that BP 20 years ago was a $250 billion company? Today it's less than 100. And so what the very different kind of stakeholder push that has played out for the Euro majors, and BP has been more than a willing participant in actually taking action to move in the direction that the activists and the broader ESG and EU community have been, dominant in terms of the rhetoric and the policy making. But you've got a company that went from, at the beginning of Bernard Looney's short tenure as CEO, saying we're actually going to contract our oil production by 40% by 2030, reducing that to 25% and then reversing course, kind of in concert with the IA. The problem with that is you spent a ton of capital on a lot of things that now make up that multi-billion-dollar impairment. And that's, a lot of that is kind of mark to market based on kind of rational and realistic valuation today for those types of assets versus, I think the number on actual offshore wind leases in one case for BP was, back in the day, was something to the tune of $600 million. But you spend a few $600 million chunks over time, and then you mark that up in the market, then you've got, you've got elevating impairment risk. So kind of here we are.
So it's actually really interesting. I'm sure there'll be some Harvard Business School case studies on this, because it's a case study rich sort of environment. It's what are we good at? And it's so there's a couple. I think about this a couple ways. One, what are we good at? Well, let's keep doing that. Are we good at this other thing? Well, maybe we shouldn't do that. Let somebody else do that, and let us do what we're good at. And whether BP was good at extracting oil and gas or not, I think even that's questionable given the rash of things like Macondo, Alaskan pipeline leaks, the problems and challenges at Thunder Horse, BP Texas City. I mean, I think you have to ask.
Yeah, that's more operational.
Are we even good at that? Well, if we're not, then maybe we shouldn't go chasing windmills. I mean, and And I think
it was a quixotic quest.
yes, it was. And so one, or what are we good at? I mean, oil and gas companies don't own their own rigs anymore. They don't own their own frac fleets anymore. They don't even do their own services because they're not good at it. Service companies are better at fracking wells than oil companies are. Drilling companies are better than drilling. What makes an oil company think they're going to be able to go do wind and solar and geothermal?
Well, you remember back in the day, good point about the forward and backward integration. We saw a lot of it in E&P, some notable examples. Chesapeake had a drilling company. I think Pioneer had a pressure pumping company. They may have had a rig company too. I don't specifically recall, but oil and gas valuations today in public markets are nothing to write home about. But we saw evidence of that type of portfolio diversification outside of the core, closely related to the core, result in almost every case multiple compression relative to kind of the peer comp average. And what I think it was in 2024 at Collide's Empower conference, Bobby Tudor spoke, and we're talking about, at the time, there was a lot of criticism because there wasn't more aggressive spending. It was the UN's Guterres, it was Birol at the IEA, and just the other kind of very loud voices saying that oil and gas companies aren't doing enough in terms of capital commitment right now. And he said, look, I think it was the top 7 of the majors that would include, the big US 2, BP and Shell, Total, Conoco Phillips, et cetera. But their combined total capital was like $122 billion. And if you remember at that time, the IEA is out saying, and everybody else is out saying, we got to be spending, we need to be going from $1 trillion a year to $3 trillion. And Bobby's point was just pointing out the absurdity of the proportions of that $122 billion. If the go forward is somewhere between 1 and 3 trillion, if they put 100% of their capital into transition investments, it really doesn't matter. It's, it gets detached from financial and execution reality to begin with. But for an industry that had been, since 2014 has suffered from, I think, kind of a structural repricing or revaluation, and not in a good way, doing this type of stuff at speed and at scale is, as we see in retrospect, and I think most of us really understood that this was what was coming, because physics always wins over platitudes. And, so here we are.
Well, the other thing that was interesting is you could see it. There was a lot of capital chasing not that many quality projects. And that's a space you don't want to lean into, right? You say, well, okay, but they had a strategy, they had a goal, and they got rewarded for that, at least in the press. So they got a lot of attaboys. The challenge with the market or some change in strategy is it's easy for investors to switch out of your stock. It's really hard, and you're seeing it, it's really hard to turn strategy. We shifted strategy to this, and it's not working. The market sees it, and they go off and chase the next thing. And now you're stuck with a ship that's headed in the wrong direction and a debris field of write-downs. I mean, what? So you got to be really careful about the flavor of the day and make sure, again, are we good at that? Is it something we should be doing? And I think I think again, for us, you're right. It was clear this wasn't going to end well, and well, it hasn't.
Yeah, I recall back in, I think it was in September of 21, Chevron rolled out its new energies business. Uh, uh, and they clearly had in their stack of opportunities. Wind and solar were absent. And I remember them Mike Wirth getting taken to task. And he basically said, look, we can't generate competitive returns in those two areas. And that's just the blunt reality. And, sticking with that discipline and really understanding the kind of the Exxon and Chevron model. And I know Shell and BP and the rest of the, the more progressives that went much farther down the path, including committing to Scope 3, we're looking across the pond saying, that's really the rational path, but we have been forced by kind of the environment we live in or the house we live in, defined as Europe, to actually do some things which in the end have been proven to be fairly shareholder value destructive.
Yeah, so maybe the right answer is keep producing oil and gas and keep trying to do it cleaner.
So Follow This is I believe it's a Dutch activist, and they've been a gadfly since 2016, just bombarding proxies with resolutions that were very one-dimensional in terms of, things like forcing BP to do what it did and projecting that they were going to contract their oil production. It was all emissions and climate focused. And now they've kind of, that they've lost the IEA as an ally, for example, and these resolutions have seen pretty declining proportions of support over the last few years. Follow This came out with something. Now they're demanding that the European majors, Shell and BP, set forth a 10-year outlook on what their investments in oil and gas will do from a returns profile. Now all of a sudden they're investors like everybody else.
Yeah, now returns matter.
Yeah, returns matter, but this notion that all of a sudden we're going to take the high road here and we're really going to put you to task for the investment community and saying, okay, we know you guys have pulled back from this transition pace. You're not going to let your core oil and gas production decline. If you're going to grow it out to 2050, we need a 10-year look of what that investment landscape looks like, which is,
yeah,
I don't know, I found that cynically amusing. Anyway, it's going to be fun to watch all this play out. And I guess the last question on BP, what's your guess? Is BP still a standalone company by the end of this year?
Yeah, I think so.
I'll take the other side of that without knowing, but having had some experience with Elliott, I don't think they're going to turn that loose, and I think Meg O'Neill's being brought in.
Well, that's true. That's
to do
good, that.
Yeah,
I think that's right. The question is, what is it? Yeah, I was just thinking about who wants it and how do you break it up. That's another discussion.
Speaking of renewables, last item. I was fascinated because it had never hit my radar that Tesla is building and has built and is now operating a lithium refinery in good old Robstown, Texas, which is about a sand wedge from where I grew up in Corpus. And this thing does not use traditional sulfuric acid leaching. It is a kiln and alkaline process, a rotary kiln and alkaline process that uses as kind of ore feedstock, which is high in lithium. Is it lithium oxide concentration? um, a rotary kiln, and then an alkaline process for leaching, and you're left with battery grade lithium oxide, enough to produce somewhere between 500,000 or batteries for 500,000 to 1,000,000 EVs per year. And do you know what the timeline was from ground break to operations?
No, I'm sure it was faster than anybody else could have done it.
19 months.
That's amazing at that scale.
And so the quote unquote waste products are, things like sand and lime, which are components in concrete or constituents of concrete. So this is very analogous to what XAI and Elon have pulled off in Memphis with the Colossus 1 and Colossus 2 supercomputers. One of my favorite things to talk about is we've spent a lot of time talking about kind of the AI arms race and data center build out and energy and power related to that. But Colossus 1, right there in Memphis proper on the river, went from groundbreaker concept to first power in 134 days. And it started with 200,000 GPUs, and they added another 100,000 a few months after they started it. Well, kind of the speed element there was that they took a little bit of a different approach. They took an abandoned industrial building on the Mississippi River, decided to ask for forgiveness rather than permission by moving in a 35 mobile turbine fleet of gas generation. And then they secured another spot down in Whitehaven, which is a slightly southwestern suburb of Memphis, got that online in about 150 days. And oh, by the way, we're going to move across the border and buy an old Duke gas-fired power generation asset, and we're gonna rebuild there to the tune of, I think, 1.2 gigawatts. So moving back to the lithium refinery model, they are uniquely proving to do things at scale at timelines that are breathtakingly short.
Yeah, it goes against what we talked about BP. Stick to what you're good at, and apparently they're pretty good at a lot of things. But I do think the difference is, you've got a company that trades at an incredibly high multiple, and they're securing the things that keep that multiple high. I need lithium for batteries, so I'll make sure I've got some of my own supply. I need power to generate, to feed the data centers, the AI, the things that power feeds in my business. So I'm going to secure that, and I'm going to do it quickly. I'm not going to sit around and, he kind of flips the script. Instead of saying, well, how does everybody else do it? It's more, well, how can we get it done the quickest? And it's similar to Microsoft's in some ways, saying we're gonna go secure power from 3 Mile Island. Now they're going to do that as quickly, but we need the power, so we're going to secure it. And you look at these companies that trade at a high multiple. They're trying to lock in the things that continue to keep those multiples high. The ability to create batteries and sell cars, the ability to generate power and do AI and data centers. So it is interesting.
It's just another kind of feather for Texas too, because you got SpaceX down there in deep South Texas in the Brownsville area, South Padre. You've got, what's going on around DFW with, I think, second largest concentration of data centers. But to be able to do something like lithium refining is, somewhat akin to building, people would think about it in a traditional way. Well, there's a bunch of really hazardous stuff that is used in traditional refineries or any kind of leaching process, they found a way to do it differently, but also do it quickly. And they had a very kind of willing partner in the state that they're continuing to build these new examples of, next generation technology. And so I think I just think it's an interesting example and one that caught my eye. We at Collide, at least our leadership loves their Teslas. But it's just an important, it's an important statement and step in terms of de-risking the inherent supply chain issues related in the. Oh, and by the way, you get to say a big piece of your EV is actually manufactured from the ground up in the U.S.
Right, the most expensive part of that EV.
All right, well, I don't know about you. It feels like a pretty broad spectrum of interesting stuff, and I'm really glad you're able to join us to get back into Venezuela, Iran, and one of our long-running favorite subjects, which is petroleum data. It's got a fair bit of controversy around it, and I think having your expertise and perspective is very helpful.
Yeah, I think the market is going to be fun to watch over the next 18 months, for sure.
All right, man. Well, good to see you.
Yeah, good seeing you. Thanks for having me. This is always fun.
I'll be in Houston here a week after next, and look forward to doing some more in studio shows, so we don't have to deal with our collective my incompetence.
Combined old guys in technology are tricky sometimes, and part of it was my fault.
Collide, if you like the show, please share it, give us a like, and tell your friends to sign up and register for Collide and get the best, most interesting kind of expertise and commentary right at your fingertips. So we look forward to the next one. Dave, have a great weekend, and we'll talk soon.
Yeah. Thanks again. You have a great weekend too.